Hey, welcome back to the Consulting Mind. Today, we are going to talk about the Bank of Japan's latest yield curve control policy. Even though you might not be investing in Japan-related asset class, be it bond or equity, or you might not even have the interest to explore that, it is still worth you to spend some time to look into these matters because the change of Japan yield curve control policy will not only affect Japan local market as a price. It will bring huge implications to global financial market and the pricing logic behind. And we are going to look into this in details. So let's first talk about what happened. On the last year, 20 December, the Bank of Japan announced a very significant changes on the 10-year government bond yield and make the target range from 25% basis point to 50% basis point. Officially, the Bank of Japan did not claim that it is a rate hike, but effectively, we all know that it is a rate hike, and the government bond yield will go up as a result of the policy changes. At the same time, the Bank of Japan also expand the QE scale from 7.3 trillion yen to 9 trillion yen per month starting from this year quarter one. So how did the Japanese bond market react to these changes? And obviously, it goes straight headed to the 50% basis point target range of the maximum bound. And at the same time, you can also see that the bond market started to getting volatile. Once the policy new target range have been announced, you can see the bond yield go straight to the maximum bound of 50%, and then it go ups and down, and has been hovering around the target range of the maximum cap. Then we can look into the rationale for why Bank of Japan uh, need to make such a huge change. Basically, it is kind of similar to what happened in US and Europe, that the inflation rate has been rising significantly. As we all know that Japan and US has been printed a lot of money with lots of quantitative easing over the last decade. And yet, the inflation has been muted and disappeared. But now you can see that inflation has been coming back. You can see that the inflation rate in Japan has been raised to 4% in the latest data, which is also the highest level since 1981, which is also a very huge alert to Bank of Japan that it is time for them to do something to curb the inflation from further rising before it is too late. So then it take what has been taken as a central bank, which is started to tighten the monetary policy, started to reducing the liquidity into the market. We can move on to talk about a very crucial and fundamental concept here, which is why the Bank of Japan tightening monetary policy will also affect the other financial market. So first, we have to understand that there are lots of institutional investors like the hedge fund, the pension fund. They will leverage yen for some arbitrage trade, where they will take advantage of the low yen foreign exchange price and interest rate for some sort of carry trade. And how did it work in particular? First, those institutional investors will borrow yen locally, and then they will leverage on the foreign exchange swap to change the borrowed yen to USD, and then they will invest in USD bond market. And why did they do so? Because they can gain a lot from the yield spread. Like for example, the current 10-year government bond yield is close to 0.5%, right? But now, the 10-year government bond yield in US has already been raised to a level of close to 3.5% after various rounds of rate hike by the US Fed. So effectively, it means profit gap or profit spread close to 3%, and not to mention the FX spread gain afterward. But this sort of carry trade do have some risk involved, which is imagine when there is a reverse trend of yen, like when the Bank of Japan start rise the interest rate, when the Japan yen has started to rise because of the rising interest rate, everything will be changed upside down. Effectively, it will mean higher borrowing costs by those institutional investors, and it will also mean a potential loss when they reverse the trade to Japanese yen, when they sell the USD bond and change the FX back to yen. So in order to manage the risk, in order to manage the risk exposure in this type of carry trade, when those foreign institutional investors feel like that there are some risk for the Bank of Japan to reverse the policy, they will start doing the action of selling USD bond and change the FX back to the yen. And this will naturally brought some volatility or some asset pricing pressure in the market. So what does that mean to financial market in 2023? As mentioned before, even though you are not currently investing in Japan market, financial market, the change of the Bank of Japan monetary policy will also be a very key item that you have to be focused on in this year, because it will mean that a lot of cheap and massive funding from Bank of Japan might be disappearing in this year, which will also bring a very huge volatility in other financial markets as well. So this is the end of this episode and hope you like that. And please click the like and subscribe button for me. See you soon.